Hello and welcome to the DIY Investing YouTube channel. We're working through every company in the S&P 500, and today is Dupont De Nemours, ticker DD. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. First up, this is a market cap of $35 billion, enterprise value of $44 billion. It has about $9 billion in net debt. It's a chemicals industry, so you can see they're using some leverage on their assets. So here's a little bit of a business description. They provide technology-based materials and solutions in the United States, Canada, Asia Pacific, so basically the entire world. 3 segments: electronics and industrial, mobility and materials, and water and protection. So they supply materials and printing systems, advanced printing industry, fabrication semiconductors, manufacturing. See mobility and materials, engineering resins, going into, is this automotive? Advanced into engineers and designers, transportation, electronics, renewable energy. Water protection goes into worker safety, water purification, and separation. So very diverse business here. Says the company was formerly known as Dow DuPont, changed its name to Dupont De Nemours, and is headquartered in Wilmington, Delaware. So some of the data here is going to be really interesting, with some of these changes in June 2019. So the data is going to jump all around, but we'll see what we can make sense of with the data that we have. Now, return on invested capital, the first thing that you notice with this chart, if you're me, is that this is a very cyclical business. You can see the return on invested capital having 2 very clear cycles. You go up, so you basically are down in 2002, up in 2005, down in 2009, up in 2015, down in 2020, and it looks like you're on your way back up again in 2021. So you've done 2 full complete cycles, means that maybe there's 1 cycle averaging every decade, 3 to 5 years on the way up, 3 to 5 years on the way down, a couple of years at the bottom. This is a textbook cyclical company. You see that they have 1-2 years of losses in the last 20 years, which is not terrible, but you have quite a few years with low returns on invested capital. We see 1, 2, 3, 4, 5, 6, 7, 8 years that are not losses but are quite low on the return on invested capital in the 5% or less range. And then you have the remaining 10 years on a much higher level. So the problem with cyclical companies tends to be that they're going to have a relatively high average return on invested capital compared to some of their lower number years because of the high end years. But when you average it out on a arithmetic basis, you're just adding everything up and dividing by 20. When you average it out on a compound annual interest basis, it's actually worse than that. So the 10-year median return we have here is 5.7% return on invested capital, but you should expect the actual return on invested capital to be lower because of how compounding works. And so especially negative years really punish this return on invested capital number. Likewise, the return on equity of 10% probably overstates the return on equity. Now, I do like to see a 10% return on equity, but you get into a problem once you start seeing these very cyclical numbers and once you see negative numbers averaged into this. So I would expect the average return on equity to be below 10%, which is really where you have a problem here. You have a low return on invested capital, relatively low return on equity. This number is ideally 15%. This number ideally is 10% plus, because what that allows for is as that compound number is lower, you can still get your double-digit returns. You're really wanting a 15% return on equity because that allows for 10 to 15% return for shareholders. This number tends to be the upper end of what shareholders expect. So you're looking at this number and saying, okay, I'm not expecting very, very high returns because of that. Now, where our analysis gets kind of complicated is some of these mergers and splits that took place here. So, it looks like they merged into Dow DuPont. They split up into DuPont. So you had this change in assets, change in revenue. You can clearly see they started the decade with $56 billion in revenue. They ended in $16 billion in revenue. And so that looks like a major problem. But really what you have is in 2017, you had a big drop off here. You came back up in 2018, down again in 2019. So it's going to be very hard to look at these CAGR numbers because they're not telling the full story. What we can see is that for these years that looks like nothing is taking place, you're still not doing great in terms of overall growth. Even in recent years where it looks like you're post-acquisition, post-mergers, you're still not doing great with your numbers. Now, obviously we had COVID in here. That can play a big role into this, but you're not seeing a lot of growth here. And the lack of growth becomes a big concern because when you see a PE of 18, that's really assuming that the company is growing. You don't want to pay a PE of 18 if the company is not growing, because what a PE of 18 translates to is about a 5.5% earnings yield. That earnings yield is going to cap your return on investment as a shareholder if you're not growing. And so you're saying, okay, I have a 5.5% cap here, I have a 10% cap here. You're in that range of 5.5 to 10%. But again, that's assuming you're able to grow. So we really need to understand, is this business capable of future growth, or what's going on here? And the cyclicality makes it very, very difficult to see, because you can't look at this and say, oh, I can expect 5-6% growth in the future. I can expect 10-15% growth in the future. You have some years that are up, you have some years that are down. It's very unpredictable. Likewise, these EV to EBITDA numbers, EV to pre-tax numbers are telling you this is an expensive business. You have a lot of debt on this business, and that shows up here. These are not cheap numbers. You'd really like to see these numbers below like 7, and yet we don't see that because of this $9 billion in leverage. You're really leveraging up a business that's not growing very much. Let's see. Earnings per share. We're going to have to go... We need to take a look at the other pages. So if you're enjoying this video so far, hit that like button. Don't forget to subscribe. You can get a list of all my videos at the end of this episode. So income statement. We want to come here. Actually, I'm going to skip ahead to the balance sheet. I want to see if I can see where these acquisitions took place. Changes in retained earnings. So there's a big drop here. I mean, it's clear 2019 is that year. Cash flow statement. Do we have acquisitions? So no acquisitions there. You did have a big acquisition here in 2017, so that's showing up at a big amount. Both PP&E, acquisitions, investments. If we go to the balance sheet, we should be able to see the goodwill changes. Yeah, so you see they made a big acquisition in 2017, which is why this went from $15 billion to $59 billion. They then dropped down in 2018, and then they dropped down again in 2020. So this is, basically a spinoff here and a spinoff here. So you have two different spinoffs, a big acquisition, and that's redistributing the asset base of this business. What's concerning is that you started at $70 billion in assets, you end at $45 billion in assets, and yet the income statement doesn't really show that sort of change. I mean, well, it's similar. On a net income number, this looks really, really good, but something is weird here. Why does it jump from a pre-tax income of $2 billion up to $6 billion? That doesn't make any sense. So this is my better number, $1.8 billion. So if we said this is $3.50, so and the other thing, look at these shares outstanding. I mean, you've really gone up a bunch. You doubled your shares outstanding because part of this is this acquisition. You get up to 736 million. Then you distribute again, 544 million. This is a very difficult business to assess. Very, very difficult business to assess. They're using a decent amount of capital. So what do you say? 45 billion in assets. Let's look at a number here. You're not getting a high return. That is like a 5% return on capital. So that number's right. So for me, this is a very difficult company to assess in this way. What you'd want to do if you're interested in DuPont, if you're not at DuPont, if you're interested in DuPont, you'd want to take a look at the most recent 10K. 2021 10K. You need to read that 10K to make your analysis, because the history here is so complex that it's really making it difficult to make an assessment simply based on the numbers. So you need to look at the 10K and how they describe the current business and make a judgment based on that, because the current business is all that's going to matter for you here. And so you're saying, okay, and it's not even that $11 per share. You need to go to this income statement. Let's say do the 12 months and say, okay, I have $2 billion in profit. What is $2 billion in profit worth? How quickly is it growing? So my $2 billion in profit is, $3.50 in EPS. If it's growing, maybe that's worth a 15 multiple. And so we were talking about $45, $50 a share. If it's not growing, maybe it's $35 a share with a 10x multiple. So, and you're trading above both of those numbers. So it looks kind of expensive either way. You're putting a PE of, that 20 PE. But you really need to assess the growth. I think the price is a little high anyway. I think I'd want a PE of 15 or less. If it is growing, PE of 10 or less. If it isn't growing, and if it isn't growing, it's not super attractive either, because your returns on capital aren't that high. So for me, DuPont won't go on my watch list. If you found it interesting, though, please hit that like button. Don't forget to subscribe. Ring that bell to get notified Monday, Wednesday, Friday. New videos, new companies. We're looking at the whole S&P 500. I have a playlist at the top of my 150 other companies that I've already covered about the S&P 500. I found some really good ones in there, so I hope you'll check out that watch list. Check out that playlist. And if you're interested in using this software to do your own analysis, you can get a free or paid account at quickfs.net. The first link in the description below is my affiliate link. You can sign up for an account there. I get a commission for sending you over to them, and I hope you will check it out. Again, free or paid account. You can use this software. I think you will get a lot of great use out of it. Thank you for listening. Until next time, stop paying fees, start building wealth.